All right, let's dive into something that might seem a little dry at first,
Yeah.
but trust me, it's got some real drama. We're talking about the December 15th press release from the Ministry of Finance, all about public sector banks.
Those PSBs, huh?
Yeah. Sometimes those financial reports can feel a bit like, well, reading a textbook. But this one's got a story to tell. It's about a comeback, a real underdog story.
A comeback story. I like that.
And that's what we're going to unpack in this deep dive. So first things first, maybe not the most exciting part, but got to lay the groundwork. What exactly are we looking at here?
Well, this report is basically like a health checkup for our public sector banks. It tells us how they've been performing, what challenges they're facing, and what steps they're taking to, well, shape up.
So like a fitness tracker for the banking world.
Exactly. And just like your fitness tracker shows you your steps and calories burned, this report gives us all the juicy details about profits, losses, and those pesky non-performing assets we always hear about.
All right, so no more beating around the bush. Let's get to the good stuff. What's the headline here? What's got you, like, really excited about this report?
Honestly, the sheer scale of the turnaround. I mean, we're talking about public sector banks racking up a net profit of 1.41 lakh crore in the last fiscal year. That's not just a win, that's a victory lap.
Okay, whoa. That's a lot of zeros.
It is, and it shows that something's working, right? This isn't just a fluke. The momentum's carried into the first half of the current fiscal year, too, with profits hitting 85,520 crore.
So they're not just, like, resting on their laurels.
Not at all. This consistent growth tells me there's been a real shift in how these banks are operating, a real focus on, well, getting their act together.
So what's the secret sauce? What's behind this impressive turnaround?
Well, it's not magic, that's for sure. It's a combination of factors. For one, their asset quality has vastly improved. Fewer loans are turning bad, which is a huge relief.
Makes sense. Less risky business means a healthier bottom line, right?
Precisely. And they've also gotten a lot more efficient. They're streamlining processes, cutting costs, basically doing more with less, which is always a good sign.
So they're leaner and meaner.
You could say that. And let's not forget their capital base. They've really strengthened it, which gives them a nice cushion to absorb any unexpected shocks.
So they're prepared for those rainy days, which is, always a good thing. But let's be honest, it's not all about the banks, right? This success trickles down, doesn't it?
Oh, absolutely. The government, as a major shareholder, is definitely reaping the benefits. We're talking about 61,964 crore paid out in dividends over the past 3 years. That's money that can be used for, well, all sorts of good things.
Like infrastructure, education, all that stuff that needs funding.
Exactly. So, yeah, this turnaround is a big deal for the banks, but it also has a ripple effect on the entire economy.
Okay, so far so good. We've got a pretty rosy picture here. But I know you're not one to sugarcoat things. What are some of the potential risks or challenges that could throw a wrench in the works?
Well, the world's a pretty unpredictable place. The global economic climate can shift quickly, and that can definitely impact our banks. And let's not forget the competition.
Ah, yes, the fintechs. Those nimble, tech-savvy upstarts who are like shaking things up.
Exactly. They're going after the same customer base, and they're not afraid to experiment. How PSBs adapt to this new landscape, how they innovate and stay relevant, that's going to be crucial.
So it's not all smooth sailing from here on out.
Yeah,
They got to
yeah.
stay on their toes.
Oh, yeah, definitely. But, I'm optimistic. I think they've shown that they're capable of adapting and evolving. They've already overcome some major hurdles, and I think they're ready to tackle whatever comes next.
Okay, so they've got the fighting spirit, which is great. Now, let's dig a little deeper into one specific issue that's always a hot topic when it comes to banking, GNPA. Now, for those who might not be familiar with this acronym, what exactly does it stand for, and why should we care?
GNPA stands for Gross Non-Performing Assets, and it's basically a measure of how many loans are going bad.
Like people not paying back what they borrowed.
Exactly. And a high GNPA ratio is like a red flag. It means the bank's taking on too much risk, and that can spell trouble down the line.
So how bad was the situation, and how much has it improved?
Well, back in 2018, things were pretty scary. The GNPA ratio hit a peak of 14.58%, which is, a significant chunk of loans going sour.
So almost 1 out of every 7 loans was in trouble. That's not ideal.
Definitely not. But fast forward to today, and the picture is much brighter. The GNPA ratio has plummeted to 3.12%.
Whoa, that's a huge improvement.
It is, and it's a testament to the efforts that have been made to clean up the system.
Okay, so now I'm really curious. What exactly did they do to achieve this dramatic turnaround? I mean, how do you even begin to tackle a problem of that magnitude?
Well, it wasn't a quick fix, that's for sure. It involved a multi-pronged approach, and a key part of that was something called the Asset Quality Review, or AQR.
AQR. Got it. Now, I have to admit, when I first read about this in the report, I was a little confused because it seemed like it actually made things worse initially, like it exposed even more bad loans. So how did that help in the long run?
Think of it like this. Before you can fix a problem, you got to know exactly what you're dealing with. The AQR was like shining a bright light on the true extent of the bad loan issue. No more sweeping things under the rug.
So it was about facing reality no matter how unpleasant.
Exactly. And that transparency was crucial. It allowed for a more focused and effective approach to tackling the issue.
Okay, I'm starting to see the logic here. So once they had a clear picture of the problem, what did they do about it?
That's where the famous 4R strategy comes in.
Ah, yes, the 4 Rs. I've heard whispers of this legendary approach.
It's not just a legend, it actually worked. So those R's stand for recognition, resolution, recapitalization, and reforms.
Okay, 4 big words. Break it down for us. What did each of those entail in practice?
Sure, so recognition, as we've already discussed, was about accurately identifying those problem loans. No more pretending they didn't exist.
Got it. So what about resolution? How did they actually deal with these bad loans once they were out in the open?
Resolution involves setting up special mechanisms to handle these loans more efficiently. Think of it like creating a fast track for resolving these issues.
So less bureaucracy, more action.
Exactly. And then there's recapitalization. This was about injecting fresh funds into the banks, basically giving them the financial muscle they needed to get back on their feet.
So a much-needed boost to their bank accounts.
You could say that. And finally, reforms. This was about addressing the root causes of the problem, improving governance, tightening lending practices, making sure history didn't repeat itself.
So not just a Band-Aid solution, but a long-term fix.
Exactly. And I think that's what's so impressive about this turnaround. It wasn't just about addressing the symptoms, it was about fundamentally changing how these banks operate.
That's a great point. It was a holistic approach, tackling the problem from all angles. So we've talked a lot about the financial health of PSBs, but I know there's another aspect to this story, something that goes beyond profits and balance sheets.
You're talking about financial inclusion, right?
Exactly. What does that mean, and why is it so important, especially in a country as diverse as India?
Financial inclusion is about making sure that everyone, regardless of their background or location, has access to basic financial services. Think bank accounts, loans, insurance, the tools people need to manage their money, build businesses, and protect themselves against risks.
And PSBs have a crucial role to play in making this a reality, right?
Absolutely. They have this vast network that reaches even the most remote corners of the country. For many communities, they're the only formal financial institution in town.
So they're not just about making money, they're about making a difference in people's lives.
Exactly. And that social impact is something that often gets overlooked.
Well, this report definitely doesn't shy away from it. It highlights some pretty impressive numbers. For example, the number of bank branches has grown significantly, from 1,017,990 in 2014 to 1,060,501 in 2024. And there's a clear focus on expanding in rural and semi-urban areas.
Yeah, and that's a huge undertaking, but it's essential. Bringing more people into the formal financial system, giving them access to credit, helping them build assets, that's how you empower communities and drive inclusive growth.
It's about leveling the playing field, giving everyone a chance to participate and prosper.
Precisely. And it's not just about brick and mortar branches anymore. We're also seeing a big push towards digital financial services.
Ah, yes, the digital revolution. Even in the remotest villages, people are using their phones for everything these days.
Exactly. And that's creating new opportunities to reach the last mile, to connect those who might have been excluded in the past.
So it's a combination of expanding physical reach and embracing digital solutions to bridge the gap.
It is. And that's where government schemes like Yandan, Mudra, and Kisan Credit Card become really important. They provide targeted support and access to finance for those who might have been left behind.
It's about making sure that everyone benefits from this financial transformation, not just a select few.
Exactly. It's about creating a more equitable and inclusive financial system.
Now, there's one more thing I want to dig into before we wrap up this part of our deep dive. It's something that really caught my eye in the report, the EASE framework.
Ah, yes, ease. Enhanced access and service excellence. It's kind of the secret sauce behind a lot of the positive changes we've been talking about.
Okay, I'm intrigued. But let's be honest, that name doesn't exactly scream excitement. What exactly does ease entail, and how does it translate into real-world improvements for both the banks and their customers?
Well, it's all about making PSBs more efficient, more customer-centric, more, well, fit for the future.
So it's not just about window dressing, it's about a fundamental shift in how these banks operate.
Exactly. Ease focuses on key areas like prudent lending, robust risk management, leveraging technology, and developing human capital. It's about building a stronger foundation for long-term success.
Okay, I'm starting to get a clearer picture of how ease is driving these positive changes, but I'm curious about the specifics. Can you give us some concrete examples of how this framework is being implemented in practice? The nitty-gritty details.
Sure, let's dive into some of those details. One area where it's making a big difference is loan appraisal. Instead of relying solely on, gut feeling and subjective judgment, there's a shift towards data-driven processes.
So using hard data to make more informed decisions.
Exactly. This helps ensure fairness and consistency, and it also makes the process more efficient.
That sounds like a win-win, both for the banks and for those seeking loans. Does this data-driven approach also play a role in managing risks? We talked about NPAs earlier and how that was a big concern.
Absolutely. Ease emphasizes robust risk management, and one of the tools they're using is sophisticated early warning systems. These systems use data analytics to identify potential loan defaults before they happen.
So they're not just reacting to problems, they're trying to anticipate them. That's a big shift, isn't it? Are there any other examples of how ease is transforming the way PSBs operate?
Another area where we're seeing significant change is in loan processing. Remember those mountains of paperwork and long queues we used to associate with banks?
Yeah, I definitely remember those days. Not exactly a fond memory.
Well, Ease is pushing for a more streamlined digital approach. Less time spent shuffling papers, more time focused on actually serving customers.
So less hassle, more efficiency. I bet that's a welcome change for everyone involved.
It is, and it's not just about back-end processes. The report specifically mentions tech-enabled smart banking. I'm curious, what exactly does that look like from the customer's perspective? Imagine this. You're at home and you need to, say, apply for a loan or check your account balance. Instead of having to physically go to the bank, you can do all of this through a user-friendly mobile app or online platform.
Ah, the convenience of modern technology. It's pretty amazing how much has changed in just a few years.
It is, and it's about making banking more accessible, more convenient, more, well, in tune with how people live their lives today.
That's a far cry from the days of standing in line for hours.
Yeah.
And for someone like me who's always on the go, that kind of convenience is a game changer.
Exactly. But, even with all these advancements, there are still some challenges. Digital literacy is a big one. Not everyone has the same level of comfort with technology, so there's a need for education and awareness building.
That's a good point. We can't assume that everyone has the skills and knowledge to navigate this digital world.
Right. And then there's the issue of reliable internet access, especially in rural areas. These are things that need to be addressed if we want to truly bridge the digital divide.
So it's not just about building the technology, it's about making sure that everyone can access and benefit from it.
Exactly. It's about creating a more inclusive and equitable digital financial ecosystem.
Now, we've talked a lot about the positive changes happening within PSBs, but there's also a bigger picture to consider. We mentioned earlier the rise of fintech companies. How do they fit into this evolving landscape, and how are PSBs responding to this new competition?
That's a great question, and one that's on a lot of people's minds. Some see fintechs as a threat, these disruptors who are coming in and shaking things up.
And to be fair, they are pretty disruptive. But, disruption isn't always a bad thing, right? It can force innovation and lead to better outcomes for everyone.
Exactly, and I think that's the key here. Instead of viewing fintechs as the enemy, there's a huge opportunity for collaboration. Fintech companies are often very agile and innovative. They're good at, thinking outside the box. PSBs, on the other hand, have a vast network, established infrastructure, and that trust factor that comes with being a long-standing institution.
So they each bring something different to the table.
Exactly. And by working together, they can create something truly powerful, something that benefits both parties and ultimately the customer.
So it's not about one winning and the other losing. It's about finding ways to cooperate and leverage each other's strengths.
Precisely. It's about creating a more collaborative and dynamic financial ecosystem.
Well said. Now, we've covered a lot of ground today, from the impressive financial turnaround of PSBs to the challenges and opportunities they face in this rapidly changing world. It's clear that these institutions are no longer the slow-moving giants of the past, but dynamic forces shaping the future of India's financial sector.
It's been quite a journey, hasn't it? And, I think the most exciting part is that this story is far from over. There's still so much potential for growth and innovation.
So what's next for PSBs? Where do we go from here?
That's the million-dollar question, isn't it?
Uh-huh.
But I think one thing's for sure. The future belongs to those who are willing to adapt, innovate, and collaborate. And I believe PSBs have what it takes to thrive in this new era of banking.
That's an inspiring thought. And on that note, we're going to take a quick break. Stay tuned as we delve deeper into the future of PSBs in part 2 of our deep dives. We'll be right back. All right, so we're back, and we're diving deeper into the future of PSBs. Before the break, we were talking about how these banks are adapting, becoming more tech-savvy, more customer-focused.
Yeah, they're really stepping up their game.
And one of the key drivers of this transformation is the EASE framework, which, as we learned, is all about enhancing access and service excellence. But I want to get a bit more specific. What does this actually look like in practice?
Sure, let's take a closer look. One area where ease is having a major impact is loan appraisal. Remember the old days when loan decisions were often based on, well, let's just say, a lot of guesswork and gut feeling?
Yeah, not exactly the most scientific approach.
Right. But thanks to ease, things are changing. There's a big push towards data-driven loan appraisal.
So less intuition, more hard data.
Exactly. By using sophisticated algorithms and data analytics, banks can assess creditworthiness more accurately and consistently. This not only reduces risk for the banks, but also ensures fairness for borrowers.
Makes sense. It's all about making those lending decisions more objective and transparent.
Exactly. And it's not just about loan appraisal. Ease is also transforming the way banks manage risk. Remember those pesky NPAs we talked about earlier?
Oh yeah, those were a real headache for PSBs.
Well, ease is helping them get ahead of the problem. One of the tools they're using is sophisticated early warning systems.
Early warning systems. Sounds intriguing.
They are. These systems use data analytics to identify potential loan defaults before they happen. Think of it like a financial weather forecast. But instead of predicting rain, it's predicting loan trouble.
So they're not just waiting for things to go wrong, they're being proactive.
Exactly. By spotting those warning signs early on, banks can intervene and take steps to mitigate the risk.
That's got to be a huge relief for both the banks and their customers. No one wants to see those loans go bad.
Absolutely. It's all about creating a more stable and sustainable financial system.
Okay, so we've got data-driven loan appraisal, early warning systems. Any other examples of how ease is changing the game for PSBs?
Well, remember those mountains of paperwork and endless queues that we used to associate with banks?
Oh yeah, I definitely remember those days. Not exactly a fond memory.
Well, ease is on a mission to change all that. It's pushing for a more streamlined digital approach to loan processing.
So less bureaucracy, more efficiency.
Exactly. By digitizing processes, banks can significantly reduce processing time and costs, which benefits everyone involved.
And I bet that translates into a much better customer experience as well. No one likes waiting in line for hours on end.
Right. It's all about making banking more convenient and accessible.
And speaking of convenience, the report specifically mentions tech-enabled smart banking. What exactly does that mean? Is it just about having a mobile app?
It's more than that. It's about creating a seamless and personalized digital banking experience. Think intuitive interfaces, personalized recommendations, maybe even incorporating things like gamification to make managing finances more engaging.
Wow, gamification in banking. That's a pretty cool concept.
It is, and it's all about catering to younger, tech-savvy customers who expect a certain level of digital sophistication.
So PSBs need to keep up with the times, embrace those new technologies.
Absolutely. If they want to stay competitive, they need to offer a digital experience that rivals or even surpasses what fintechs are offering.
Now, all this talk about digital banking raises an important question.
Yeah.
Cybersecurity. With more and more transactions happening online, how are PSBs ensuring that customer data is protected?
That's a critical issue, and one that PSBs are taking very seriously. They're investing heavily in robust cybersecurity infrastructure, implementing multi-factor authentication, encryption, all the latest and greatest security measures.
So they're not cutting corners when it comes to protecting sensitive information.
Absolutely not. Cybersecurity is paramount. Any breach of trust can have devastating consequences, both for the banks and for their customers.
So they need to be both innovative and secure. It's a delicate balancing act.
It is, but I think they're up to the challenge.
Now let's zoom out a bit and talk about the bigger picture. We mentioned earlier the rise of fintech companies and how some view them as a threat to traditional banks. But we also discussed the potential for collaboration. What's your take on this? Is it a zero-sum game? Or can PSBs and fintechs find ways to coexist and even thrive together?
I think the key word here is collaboration. Fintechs bring a lot to the table. They're agile, innovative, and they have a deep understanding of customer needs and preferences. PSBs, on the other hand, have a vast network, established infrastructure, and that all-important trust factor.
So it's not about one replacing the other. It's about recognizing that each has its own strengths and finding ways to leverage those strengths for mutual benefit.
Exactly. It's about creating a more inclusive and dynamic financial ecosystem where both PSBs and fintechs can play a role.
So think partnerships, joint ventures, maybe even some friendly competition to keep everyone on their toes.
Exactly. It's all about creating a win-win situation for everyone involved.
Now, one last question before we wrap things up. We've talked a lot about the positive changes happening within PSBs, but what about the challenges? What are some of the hurdles they need to overcome to truly thrive in this new era of banking?
Well, one challenge is attracting and retaining top talent. The banking sector is becoming increasingly competitive, and PSBs need to make sure they're offering competitive salaries and benefits to attract the best and brightest.
So it's not just about technology, it's about people.
Exactly. And then there's the challenge of keeping up with the pace of technological change. The world of finance is evolving rapidly, with new technologies and business models emerging all the time. PSBs need to be agile and adaptable to stay ahead of the curve.
So it's about embracing a culture of continuous learning and innovation.
It is. And finally, there's the challenge of regulation. The regulatory landscape for banking is constantly evolving, and PSBs need to navigate this complex environment effectively. It's about finding that balance between innovation and compliance.
It's a lot to juggle, but I think PSBs have shown that they're up to the task. They've come a long way, and I'm excited to see what the future holds for them.
Me too. It's an exciting time to be in the world of banking.
Absolutely. And on that note, we've come to the end of our deep dive into the world of public sector banks. We hope you found it insightful and informative.
And remember, this is just the beginning of the conversation. We encourage you to continue exploring, stay curious, and keep those brains buzzing.
If you enjoyed this deep dive, don't forget to hit that subscribe button and leave us a like. And be sure to share with anyone who might find it valuable. Until next time, keep learning, keep growing, and keep diving deep. So we've been exploring this remarkable comeback story of public sector banks, and it's clear they're not just relics of the past. They're adapting, innovating, and really shaping the future of finance in India.
It's impressive, isn't it? They've really stepped up to the plate.
Absolutely. But the world's changing fast, and the question on everyone's mind is, what's next for PSBs? What does the future hold for these institutions in a world that's increasingly digital, global, and, well, just plain unpredictable?
It's the million-dollar question, right? And there's no easy answer.
Right. Crystal ball's a little foggy today.
But one thing's for sure. The future belongs to those who are willing to adapt, innovate, and, well, maybe even disrupt themselves a little bit.
Disrupt themselves.
It's
It's
like-
interesting.
Think about it. PSBs have this incredible network, this deep-rooted trust, but they also have, let's say, a reputation for being a little, well, slow-moving.
Bureaucratic, maybe.
Exactly. So they need to find that sweet spot, that balance between leveraging their strengths and embracing new ways of doing things.
So it's not about throwing out the baby with the bathwater. It's about taking what works and, giving it a 21st century makeover.
Exactly. And that means becoming more agile, more customer-centric, more, dare I say, fintech-like in their approach.
Okay, so less red tape, more cutting-edge tech.
Yeah, think intuitive mobile apps, personalized recommendations, maybe even AI-powered financial advisors.
AI advisors, huh? That sounds pretty futuristic.
It is, but it's not that far-fetched. The technology's already there, and customers are increasingly expecting these kinds of personalized, on-demand services.
So PSBs need to keep pace or risk being left behind.
Exactly, and it's not just about keeping pace with technology. It's about attracting and retaining top talent. The best and brightest minds in tech, in data analytics, in customer experience design, they're in high demand.
So PSBs need to make themselves an attractive employer.
Absolutely. They need to offer competitive salaries, opportunities for growth, and a culture that embraces innovation.
So it's about more than just a paycheck. It's about creating a work environment where people feel valued, challenged, and empowered to make a difference.
Exactly. And let's not forget the importance of collaboration. We talked earlier about the potential for PSBs and fintechs to work together.
Right. Finding those win-win scenarios.
Exactly. And I think we're already starting to see some promising examples of this. PSBs are partnering with fintechs to leverage their expertise in areas like mobile payments, data analytics, and customer experience design.
So it's not about one replacing the other. It's about recognizing that each has its own strengths and finding ways to combine those strengths to create something truly innovative and impactful.
Exactly. It's about creating a more vibrant and inclusive financial ecosystem that benefits everyone.
And ultimately, that's what it's all about, right? Making sure that everyone has access to the financial tools and services they need to thrive.
Absolutely. It's about empowering individuals, communities, and the nation as a whole.
Well said. We've covered a lot of ground today, from the impressive financial turnaround of PSBs to the challenges and opportunities they face in this rapidly changing world.
It's been quite a journey.
It has. And it's clear the PSBs are no longer those slow-moving giants of the past. They're dynamic, innovative, and ready to take on the future.
They're writing a new chapter in their story, and it's one worth watching.
Absolutely. And on that note, we've come to the end of our deep dive into the world of public sector banks. We hope you found it insightful and thought-provoking.
We encourage you to continue exploring, stay curious, and keep those brains buzzing.
And if you enjoyed this episode, don't forget to hit that subscribe button and leave us a like. Share it with your friends, your family, anyone who might find it valuable. Until next time, keep learning, keep growing, and keep diving deep